some tips here for you to consider.
So yeah, so some common things that come up a lot in terms of, I guess people concerned about IRS, so repairs and improvements. The big one is to make sure that you're just got really good documentation in place for the money you're spending on the various repairs and improvements you're doing for your rentals. How you classify them on your end. I don't think you should really spend that much time and worrying about that. That would be something that's done on your tax return. But for you guys, it's more of, do I have the receipts, the invoices, the copies of checks, whatever it needs to be to substantiate those expenses, because those can be big ticket items, right? When you're looking at your tax return over and over again, as you're buying a newer property, improving it, or you're rehabbing one to kind of change how it's being used, or add some rooms or what have you, right?
Yeah. So yeah, you just want to show like a very large repair. That's one possible audit scenario. Entity. So the other way to kind of minimize, protect yourself is to consider filing entity tax returns rather than showing certain things on your personal tax returns. Now, in the rental real estate world, it's not as big of a deal as it is for maybe like Schedule C people who have a business that they're reporting on their personal return. IRS loves to target Schedule C sole proprietorships with very large revenue amounts. I don't know what the reason is.
Large losses for that matter too.
Yeah,
right?
The large losses. I don't know what this exact reason is. I think maybe they just feel like sole proprietors maybe don't have as good of record keeping. So it's more easily attacked. But so if you have a high profit or large loss Schedule C sole proprietorship activity, consider putting those in legal entities. But as a preemptive, even for clients who have rentals in on the personal return, for a lot of them, we have started to recommend filing an entity return. So the example might be you and a spouse owning rentals in an LLC. When we have a choice, do we want to just report it on the personal return, or do we want to file a separate entity return for that? That sometimes filing entity return, although might cost you more money to do the filing, could potentially lower audit risk. Again, for those of you that we have filed tax returns for, we are filing returns for, we would have already let you know if we think you are at a higher audit risk. So internally, we kind of have our own criteria where the team goes through and tries to think about who might be more likely subject to an audit. So just because you own rentals in an LLC, or in a personal name, doesn't mean you will be audited. It's something that we've monitored.
Other stuff is gathering tax documents, just in general of, when you're putting together tax returns, your documents for tax returns, really important to make sure you've captured everything, right? I mean, obviously, we always talk about making sure you maximize your deductions, capturing all the deductions, but you also, on the flip side, you want to make sure that you're reporting all the income that you've received and capturing everything, because if you're missing something, it can lead to notices from the IRS, and sometimes that can even lead beyond that to an audit if they feel like the number is, hey, you've ignored, a substantial enough stuff, right? So that's just important to kind of get your ducks in a row and make sure you're gathering all your documents.
Yeah, you just don't want to like a missed 1099 form or a missed, I don't know, just some kind of missed K1 or missed 1099 to be the reason that you're selected for audit, right? So just make sure you have, if you have the document, send it to us or send it to your tax preparer, and not let a silly mistake or oversight like that be the reason to be audited. I mean, we're not so concerned of being scared of an audit, but the audit itself, right, is very time consuming. It could be time consuming, it could be costly, it's just kind of the stress and headache. So the goal is always to avoid it if at all possible.
Along the same lines, when, kind of for the clients that we're preparing tax returns for, make sure you are filling out our checklist completely. So this is important to ensure that everything is captured, right? And we put a lot of time, like Amanda said, we continue to go through continuing education every year to kind of revise our worksheets so that it's capturing all the relevant things that are going on today. And so you want to make sure you filled out those completely, because you just don't want to miss out opportunities. You don't want to, somebody gets you missed answering a question, so it's something's missing from the tax return and the IRS comes calling. This is what we're trying to avoid, obviously, right?
Yeah. And then of course, protecting yourself from audit. This is more of a preemptive, right? If you are claiming real estate professional status, in order to use your rental losses from long-term investments to offset W-2 and other income. Make sure that you have been tracking your hours. If you haven't already last year, now is the best time. This is the second best time to track it, right? We recommend tracking it throughout the year. If you haven't done it for last year, make sure you take the time to do it now while it's still somewhat clear. Again, if anyone is supposed to be selected for audit for 2022, it's not going to be 1, 2, or even 3 years from now. And by then it'll be very difficult to remember what you did, what you spent hours on. And on this, it's the same exact conversation when we talk about short-term rentals. I know a lot of you are using the short-term rental loophole, material participation, same thing, right? We have to prove our hours if audited, if questioned. So now is the best time to firm up those hours if you haven't already.